What's good, everyone? Welcome back to Stealth to Wealth. Here today we have my boy
Liam. Hey.
Liam, can you tell the people where you're from?
I'm from China. It's kind of crazy, right?
I know. So today Liam is actually going to interview me. Liam is a new trader, so Liam is going to ask me some questions that most of you guys probably have, and I'm going to answer them today to inform you guys. So Liam, if you want to go ahead and start with the questions.
Yeah, I mean, I just started like yesterday. we
talked about yesterday. Before we start, Liam, give them a little background of yourself and how you started trading.
So I mean, I'm from overseas, from China, so I just flew in like 2 weeks ago, a week ago, and I met Charles at like, what was it, where did we meet? At like
I think we met in the hallway.
Yeah, they were in the hallway or something.
Seriously?
Oh, we were waiting for the tour, and
that's
half an hour late or something.
Yep.
And we were just talking. He got into trading or something. I'm like, I always want to start that. And he started talking about it. It's pretty interesting. And you know, I'm obviously a beginner. I just started yesterday. Like I literally just sat down and started studying about it. So I got a couple questions for you. Let's see if you know your stuff.
All right. I'm gonna try my best.
We're gonna start with something simple here.
Okay.
Exactly how long does it take to make profit from day trading? Or really, what are the phases in trading?
Okay, so it's different for everyone. That's where I'm gonna start. So I think you told me the average trader finds profitability around the 16 to 20 month mark. So it's different for everyone. Like I know somebody who took 8 years to become profitable, but at the same time I know people who took 3 months. So I would say trading, I want to break it down into, I would say 3 phases. So you have that beginning phase, which you're in right now, you're really happy, you're excited. Oh, I can make this much money in the day. I can make this much, 100K in a day. That stage is probably going to wear off in a couple of months. So that would be the first stage. The second stage is really where you have to grind and really lock in. That's probably the stage I'm in right now. So this stage is probably like, I don't want to put a time frame on it because it's different for everyone. Everybody has different journeys. Yeah. But this phase is the most important. So one way that you can speed up this phase for you would be whenever you take trades, don't just trade to trade. Yeah. Journal. Journal is probably the most important thing you can do, because when you journal, you're really analyzing yourself and you're understanding what you're doing wrong personally, not what the chart is doing wrong. The market is going to do what it's going to do. It's a question of how you can trade it or how you analyze it. So one thing that I'm in stage 2 right now, one thing that I'm doing is journaling every trade I take. Literally every single time I hit the sell and buy button, after I close out the trade, I'm analyzing, I'm writing down my reason for my winner or my reason for my loss. And what you'll see is over time, you'll start to see similarities between your losers and your winners. Yeah. And then, obviously stay away from what you're doing wrong and kind of continue to do what you're doing right.
Yeah, man. I mean, you talked a little bit about journaling. I mean, how do you manage your emotions and you maintain discipline? Like, I know psychology is just a huge part of it. I mean, how do you do that?
So, managing emotions is probably the most important thing about trading. A lot of people will say technical analysis is the most important thing.
Because you see the numbers just go down. You get frustrated.
So, one thing we have to do is, first thing is detach from the money. I told you this before. Yeah. Stop worrying so much about the P&L, but more of learning the skill.
What's the P&L?
Profit and loss.
And so I don't know. That's
a good question. Profit and loss. So basically, the P&L is just what the dollar amount is at the current time if you were in a closed position. Yeah. But one thing I would say is, like I said, detach from the money, learn the skill. Because if you really commit and learn and focus on what the skill of trading is, the money will only be a byproduct of learning the skill. But how I control my emotions. So I'm not good at it, to be honest. I'm not too good at controlling my emotions. But one thing we have to realize is, like, let's say you're in a slump or you're on a good streak. Like you've won 5 trades in a row. We have to realize every trade is independent from one another. Yeah. The last trade, let's say a strategy has an 80% hit rate. This trade I took right here was a winner, and this trade right here has no correlation between each other. Every trade is independent from itself. So one thing to control your emotions, if you get really tied up in the money, I would say size down. Yeah. So what's that mean is, like, if I were trading with 5 contracts, meaning let's say every time it moves, remember I talked about a tick. You don't remember what that is?
The kind of like the difference in price, right?
Yeah, basically whenever the stock moves, that's 1 tick. Okay. Yeah. So one thing I would say is size down. So instead of trading 5 contracts, maybe trade 1. So every tick, instead of you losing $100, you only lose $20. So that's one way you can control your emotions, because early on y'all are probably going to be tied to the money. So I would say, yeah, controlling your emotions.
I actually heard someone say like it's better to like just step away. Like, what was the quote? I think it was something like, losers keep on trading after they lose, but winners just step away.
Yeah, so like for me personally, it's gonna be different for you guys. It's gonna be different for you. I try to only trade for the first 45 minutes of the market open. So why I say that is because if you just sit at your screen all day, your mind like subconsciously will start to tell yourself that you see setups
to see
that
things aren't there.
That's to see things that aren't there.
Yeah.
Because you start to lose focus over time.
Yep.
And so if you just kind of, like I said, 45 minutes for me, because I can get in, get out, get my trades done. But it's different for everyone. But yeah, if you're on a losing streak, one thing I say, if I ever lose 2 trades in a row, I take a 5-minute break.
Yeah.
And I zoom out. So what I mean by zoom out is I trade on the 1 minute time frame. Obviously that means every candle.
To the day or something.
Yeah, I'll go back to the daily time frame, the 4-hour or the hourly time frame, and really see the direction of the market. Because oftentimes what you'll notice is whenever I take 2 losses in a row, we're oftentimes in a chop, or what we call a range.
Yeah.
So meaning like price is only staying in this area instead of momentum going up or down. Yeah. So that's how I would say I can control my emotions.
Yeah, I mean, you talked a little bit about trading and your emotions, but for me personally, when I haven't traded yet, but when I look at people trade, the only thing I'm like really confused about are supports and resistances.
Okay.
Like, what are they? You know?
Question. So a support and resistance is basically, I like to think of support like a floor and resistance as a ceiling. So let's say a stock comes down to, let's say we're trading Apple and it's at $100. So if Apple comes down to this $100 level, if it's let's say it bounces from this level. Bounce means it hits it and goes back up. This would be now a support level or a floor. If a ball comes down and bounces it, it's a support. So that's a floor. But let's say at $120, Apple gets up there, it's going up, been going up, and then it comes back down.
Yeah.
That'll be like a ceiling or resistance. So support and resistance is basically levels where a price or levels where the price of a stock has continued to bounce from the bottom up or reject, which is at the top, and come back down multiple times. So
is there like a specific way that you do this? Like, I know you can't just like plot a line like anywhere, right? You have to do something more specific.
So this is what we call top-down analysis. So what top-down analysis is, there are time frames from the yearly time frame, the monthly, weekly, they go down forever. Yeah. So what you want to do is to really find good support lines, because like you say, you don't want to just mark anything. Start on the monthly time frame. And if you see a point or a price that the stock has rejected off many times, plot that.
I just started laughing for no reason because I'm sorry.
Nah,
so, go ahead.
First interview kinks. But if you're on the monthly time frame and there's a price that the stock has continued to bounce off of, plot that and then continue to go down.
Yeah.
And so I'm gonna ask you a question. If I were to plot lines on the 15-minute, would that be stronger or weaker than if I were to plot a line on, let's say, the daily time frame?
So you're saying like if you were to plot support and resistance lines on a 15-minute timer, would it be more stronger than a 15-minute or a day?
Yeah.
Well, 15-minute has more data, so I'm guessing but it'd also be less reliable, I'm guessing? Nah, okay, let me not guess. I actually think the 15-minute would be stronger, right?
It's actually the daily.
I was going to say that, right?
But we have to think. The daily time frame would be more important because it gives us a wider range of data. When you say it has more data, actually the daily does, because it shows price has because if we look at a chart, a daily time frame is going to have a larger candle than a 15-minute. Because it covers the price of a whole day, not just those 15 minutes.
But you have like more volume in the 15-minute, right?
Not necessarily. So I wish we could pull up a image right now and show them the chart. We'll pull up one. But so you have to think: do more people trade a stock in a total day, or just a 15-minute time frame?
We have multiple 15-minute time frames, right?
Right, but
during the day, I guess you
see what I'm saying?
Yeah.
So.
Totally, right?
You say the day?
Yeah.
Yeah, the day has more time, more volume than the 15 minutes itself. Because once you think about it, the daily time frame is all of the 15 minutes combined into one over this period. If that makes sense. Sense.
You're right. The day is all 15-minute ones combined into one. Yeah, I get it.
Yeah, but you said how to make support and resistance lines. So basically, so go down through top-down analysis. Go to the weekly. monthly, daily, hourly, 4 hour, 15 minute, and find levels where price is most frequent with, or where they react with most.
Like
so
at the top and the lows? Is that what you're talking about?
that can be a support and resistance line, but let's say we're in a range. So like let's say do you know what a range is? A range is basically where like a stock is just like this.
Yeah, okay.
And it would be the range, the high and the low, and it stays in this little channel, almost like a channel. It just stays in here. That can be a support and resistance line.
Yeah.
Because the stock has bounced up from here multiple times. This would be a support line. You see
But
what I'm
like,
saying?
so you can obviously move your support and resistance lines like
Yeah.
very tiny, like to decimal, right?
Well, I don't like to do support and resistance lines. I like to do like supply zones. So why I say a zone is because the stock is not going to react to the price on the exact cent every time. Versus if we just had a supply zone of an area that the stock may reject that, we could give ourselves more room for error. You see what I'm saying?
That's true. Are there any drawbacks to that then? Why even have support and resistance lines in the first place?
Are there any drawbacks to it?
Yeah, it's a zone.
Yeah, because sometimes your zones can be too big, and maybe like it goes to the top of the zone and you enter at the bottom. You maybe get stopped out.
Yeah.
So there are some drawbacks, but like I said, it gives you more room for error if you have a support zone versus just a line, because price is not going to react to the same spot every time. So yeah,
I feel that. And okay, we talked about supports and resistances. But now let's talk a little bit about candlestick patterns.
Okay.
So do you need to like memorize them? I mean, I know there are so many, but
so candlestick patterns, that goes into technical analysis. There are two types of analysis: fundamental and technical. So what fundamental analysis is basically like the management, what's going on in the company. So things of that nature, like economic news, financials, earnings, those are all fundamental analysis. But technical analysis is candlesticks itself. So there are many candlestick patterns. Do I trade candlestick patterns? Yes, sometimes. But we have to realize 95% of traders fail, 5% succeed. So I think what do you think? The 95% of people are doing candlestick patterns, or the 5% are?
I think the 5% aren't really looking at the candlestick patterns as much as they should. Like as other people do.
Yeah.
Instead, they look at the wicks and what the story behind them.
I like that. Like you said that.
In order to predict future outcomes.
Yeah. So candlesticks, they tell a story.
Yeah.
So like you can read what so like you can tell what a stock is going to do based off of candlesticks.
The pressure and all that stuff.
Right. High volume, a lot of wicks. So yes, candlesticks patterns, they do help a lot, especially for beginner traders. But for all the beginner traders, do not try and stuff your brain with candlestick patterns versus
too late.
versus other things that versus other things in the market that are way more important, like reading a candle over what a candlestick pattern
is much more important.
Is way more important. So way more vital.
So we touched on candlestick patterns, support and resistances, but then we're at the point where we're trading, right? Let's say the learning phase is over. How do you know which strategy to use?
So that's all personal.
Yeah,
it's all of your personal opinion, your personal. So me, I used to sports bet. Sports betting is very fun. Like I kind of like that gambling aspect of it. So I'm a scalper, meaning I trade. Like I'm sometimes in a trade for 30 seconds, 30 seconds to 2 minutes. That's probably as long as I'm in a trade. So different strategy for different. Shout out Quentin Jenkins. He's actually a different trader than me. He's what we call a day trader. So he trades. He's sometimes in a trade for 15 minutes. Versus me, I'm a scalper. I'm in a trade for a minute, 2 minutes, stuff like that. So strategies all depend on your trading style. Like once I was just a day trader where I was trading on the 5-minute time frame.
Yeah.
But I didn't really like it. Like now, trading shouldn't be fun. Let me tell you. This is a quote. Okay. Good trading is boring. Fun trading. Good trading is boring. Fun trading is like irrational. It's not good for you. Yeah. So trading shouldn't be fun. Like it should be patient. You should be waiting for your setups. You shouldn't be taking every setup you see. Like I like to say, A+ setups only. So, but yeah, strategy. You'll have to find that out yourself. Okay. You'll notice it.
So you're gatekeeping it basically.
Not gate. I told you I'm a scalper, but I call it a super scalper. But it's all personal. So,
yeah. I mean, I know like when I just briefly touched on, like I've guys, it's been like a day. But when I briefly touched on strategy and candlestick patterns, I just felt like I was so overwhelmed with the amount of options that are there.
There are a lot of candlestick patterns out there, which kind of makes it almost why I like to stay away from them, just because there's so many.
Yeah.
And it's like so many to remember that.
It might just be better to trust your intuition, right?
Yeah, and then, but all of y'all are going to go through the phase of, oh, this is a bull flag. This is a ABCD pattern.
Yeah.
Like, you're going to go through that phase, but you'll realize as you keep going on, like, I was really learning candlesticks pattern. What was I doing?
Yeah.
So, but it takes time. You understand?
Yeah. So you just talked about day trading, but let's talk about the debate that's going on between them, long day and day trading, right?
It's like long-term investing?
I mean, yeah, long-term trading and day trading. I mean, like, what are some of the drawbacks on that? Like, why are you doing just like trading normally instead of
long-term? Do you mean long-term investing, or are you talking about
long-term trading? I guess like when you buy, like let's say you buy like a certain amount of stock, right? And instead of just selling in like 15 minutes, you wait like a week or two.
Okay.
So why?
So there are plenty of types of trading, but I like to break it down into three. So you have day trading, swing trading, and long-term investing. So day trading is obviously trading intraday, meaning during the day when the market's open. Swing trading is holding trades overnight. Now, swing trading can hold trades from 2 days to sometimes a couple years, depending on, that's called a leap. So that's a whole topic for a whole other conversation. Yeah, and then long-term investing it should be for some decades. So yeah,
decades.
Long-term investing, yeah. If you're in a good stock, you should.
Like when I'm 60, I can just pull out and be like,
you should hold for a generation.
Damn.
20 years, I think you should hold. Now, let me ask you. You said you want to get out in, let's say, 10 years or so. Do you think Apple's going to be higher in 6 years or 10 years?
I mean, obviously in 60, right?
See what I'm saying?
But
you want to reap the benefits,
still kicking then? Nah, it probably will be.
Yeah. But, I mean, if it's a good company, that's why it comes to fundamental analysis.
Yep.
So, so let me break that down. You should do both. There isn't an either or. You should day trade or long-term invest. You should do both.
Okay.
Because personally, how I like to do it is some of the money you make from day trading, obviously, you want to keep it, but invest that into long-term.
Yeah.
Because the more you invest long-term, the more your interest is just going to, compound interest is just going to keep growing. It's like a snowball effect.
Yeah.
And so, like, if you just keep investing consistently over time, obviously your account will grow at a extremely faster rate. But
are there any risks to that though? Long-term trading?
Yeah, there are some risks to it because the company may fail.
Oh yeah.
At the end of the day.
Yeah.
Like we've seen a lot of companies come and go recently. Yep. Like with the
well, one of them was like years ago though, but I don't know if you guys remember GameStop.
Yeah.
I mean, that just failed.
I mean, if we think about it today, like with the new AI, the rise of AI, like IBM and Intel used to be the Apple of the world, and now we have companies like Nvidia, AMD, and Microsoft. So there are some risks with investing long term, but at the same time, if you invest in fundamentally sound companies, it kind of takes that risk off of it. But there is a drawback to investing in those fundamentally sound companies because they might not grow as fast. If a company is stable, you're not going to get rapid growth.
You're going to have to wait a long time.
And stability at the same time. It's going to be stability or slow growth or the chance of failure and rapid growth. You see what I'm saying? So there are drawbacks. But to day trading, I think the drawbacks to day trading versus long term, you can, but you'll expose yourself to more risk. You can't get the same amount of returns that you can get long term versus just day trading. Yeah. Because obviously you have a less amount of time frame.
Yep.
But I would say both. You can really choose day trading or long term.
Yeah, and you talked about companies that fail and all that stuff. But how do you stay informed? Actually, no. Here's a better question: is it necessary to be informed about the market trends and news about a specific company, or do you just look at the chart and be like, "Hey, this is a chart"?
It is vital that you know what's going on in the market. So some ways that you can do that. You can go to investing.com to check economic data. Investing.com, CNBC is really good. Yahoo Finance, those are some 3 companies. But yes, you need to know what's going on. Because let me tell you why. I got caught in this. There's something called FOMC, which is where the Federal Reserve, they announce if they're going to raise interest rates or not.
Yeah.
And let's say there was a projection that they were going to raise interest rates by 0.25 points. but they do it by 0.50. That's going to send the market haywire.
Yeah,
it's going to get really volatile.
Yeah.
And if you're in trade while that happens,
then
you're either going to be really happy or you're going to be really mad.
Yeah.
So just stay away from that anyways and just know what's going on. So yeah, investing.com, Yahoo Finance, or CNBC are a couple of places that you can stay informed on market information. But yeah, it is vital that you understand what's going on in the market. And that doesn't always have to be economic news like earnings. So what earnings are, most companies report earnings 4 times a year or every quarter. So basically it's just recapping the performance of the company and their financials throughout that quarter. So like this is just a crazy stat. Apple made Apple makes $82 million an hour.
Jeez. That's like
yeah.
me.
Yeah.
That's like
they make $82 million, but they still miss their earnings. So and it sent the stock down. I think it's probably down about 5-6%. I'm actually red on my Apple position since earnings, but yeah, it is vital that you know what's going on in the market when, especially in trading.
Okay. Well, then does it matter what company you choose to invest in? Because we talked about market trends, but let's say you have the choice between Tesla or a pet-owning company, but the market's still the same, right? It's still going to go up and down. So does it really matter?
What company you invest in?
Yeah, like the niche behind the company.
Okay, so are you saying like if the market is down, are there other companies that still may go up?
No, I mean like, does it matter like you invest in a tech company or a wellness company?
Okay,
right?
so
Does that matter?
So we have to, and we can make investing really simple. Like, what is something you use every day?
My laptop.
What brand is that laptop?
Apple.
What's the greatest company of all time?
Google. It's Apple, yeah.
So you see what I'm saying? It can be really simple. I mean, do people use more cars or pet supplies?
But is it saturated? Like, is it oversaturated if everybody's doing this one company?
That's true. Now, when you say it's saturated, that doesn't mean you still can't get in, because when you buy a stock, that means somebody sold it.
Yeah.
So all it is just a constant fight between buyers and sellers.
Okay.
Buyers and sellers. So is it oversaturated? Like, yeah, there are only so many Apple shares in the market right now.
Yeah.
But it's just simple supply and demand.
Yep.
So yes, it does matter what companies you invest in. Like, I like tech companies because it's the future.
Yeah, I think this is the most significantly impacted niche of all time, like 3 trillion times computing software, like something crazy like that.
And I think a lot of people don't talk about it, but I think number 2 is healthcare.
Yeah.
Because we have to ask ourselves a basic fundamental question: do you think people are going to get more healthy or sick over time?
In my opinion, I think people are going to get more sick. I don't think
that's
people
what I'm
take care of
saying.
themselves.
And people are going to need constant medicine, healthcare, stuff like that. So I think healthcare, the whole sector itself is very underrated and needs to be invested in, because like you said, over time, people are still going to continue to get sick. So like we said with technology, as tech improves, that means healthcare will improve. And if you're invested in those two, go get yourself a vacation. But yeah,
I got a bit of a more interesting question. Right, this one's a bit more ethical. Right, so let's say you have a company that you know is doing bad things, but the market's like really good for it. Are you gonna invest in that?
Now that may be where you get your cons between day trading and long term. So we got to think, like, we all remember the AMC, Dogecoin, GameStop when they ran up. The companies weren't doing necessarily good things, but the market liked it. So kind of like we call it a meme stock. So it does, it's kind of confusing. But.
Yeah. Oh, speaking of Dogecoin, I actually had a question. So let's say Elon Musk tweets something about Dogecoin and he influences the market. That's illegal, right?
No,
I think I heard something about influencing the market in a large way.
It might be. Yeah, you're not really supposed to, especially somebody of his power, not supposed to do that.
Yeah.
I mean, if he was invested in it and posted it,
yeah,
he's probably going to jail. But I'm not 100% sure about that.
It was indirect, like
I know. Yeah, it was. I remember. I know exactly what you're talking about. He did, and it sent the stock going like 20%. I remember.
Yeah.
Yeah. I don't know if he got in trouble with that because he's still posting. But
he's still kicking. I don't think he really cares.
We need Elon to lock back into Tesla so he can stand the stock up. But yeah.
That's all the questions I prepared for today.
That's all you
have. Want to ask me anything? How about I be the expert now? You try to ask me something, I'll try to answer it.
What's the difference between futures and options?
All right, that's it for today, guys. Future and options. Actually, I tried looking this up because you talked about it in one of your videos. Future is a part of a share, right? No. Options, different options. No,
He's
okay,
explain
explain to me.
Okay, so options and futures are both contracts. So instead of just buying an outright share, you can buy an option contract.
Mm-hmm.
So an option contract basically is a contract, but it has an expiration date on it and a strike price. So the expiration date, like you said, remember when I talked about there's three types of trading: day trading, swing trading, and long-term investing. Options falls in between those two: day trading and swing trading.
Yeah.
So you can buy an option contract 10 years out. It's called a leap.
Oh, so you could buy it in the future.
Yeah,
right?
that's basically what it is until it runs out.
Okay.
It's going to run out of maturity. It's going to reach maturity.
Yeah.
So now we have to ask ourselves, the more time you buy for an option contract, the more it's going to be. Do you know why?
The more you spend because it takes longer, right?
True, but it's because it's giving the market more time to move in your favor. So that's why it would cost more. So like if a contract were to expire tomorrow, it's going to be a lot cheaper because the chances of the market moving like crazy is going to be low.
Yeah.
But the farther you move down, the farther out time frame you buy, the higher it's going to be the higher chance you get. So that's the option contract. We can do a whole video on options. I actually have one on this page if you scroll down to a while ago. But futures are kind of difficult to understand. The price, don't get so caught up in the price of the futures. But futures are your trading index funds itself. So like you can trade anything from commodities, which is like oil, gold. You can even trade electricity. I think you can even trade like sheep or something. Yeah. And then what else is there? And then obviously you can trade index funds like the NASDAQ 100, S&P 500, Dow Jones 30. So the futures, whenever the price moves, that's basically just like a compilation of all the companies in that index fund together, and that's what makes it move.
So that's the future. Futures are basically a bunch of companies that you're investing in instead of just one individual.
Well, that's an index fund in general, but you can trade the index fund, which is the future.
Okay.
Yeah, so you're kind of trading the future almost.
Yeah.
Because futures have expiration dates too.
Is that what it's like called, the future?
Yeah, because you're basically trading.
I see.
So like every quarter, the ticker, you know what a ticker is? The ticker is what the stock is, like the three or four letters. Like Apple, it's AAPL.
Yeah.
Like that's the ticker.
Yeah.
So the ticker actually has the month that it expires. So for the S&P 500 right now, it's MES. So what that means is March, and then S&P 500 ES. So it actually has a maturity. Like you cannot trade this contract anymore. You have to move to the next one, which will be like whenever the next quarter ends. So that's how futures work versus options. Which one do I recommend?
Yeah, which one do you prefer?
I prefer options. Now I prefer futures. I'm sorry. I started with options. Yeah. Now options, especially for someone just starting, is hard with a small account. What I mean by that is because to get exponential gains, you have to expose yourself to more risk. But with a small account, that you don't have that much risk to play with. So that's why I recommend futures. Now futures do cost more. They cost a lot more. But that's why you can get something called, you can trade through a prop firm. So what a prop firm is a company, or I won't give names, but there's a couple companies out there that you can pay like $75 to get access to a trading combine. And if you pass the trading combine, you'll get funded, let's say $20,000. Now, you cannot just deposit the $20,000. You get whatever the profit is you get. And there are different rules. Like some companies have like a 90% take. You give them 10%, stuff like that. But the trading combine is not easy. Now, I wouldn't say just hop right into a trading combine if you're new to trading. Paper trade. Take 100 paper trades before you ever take a real trade. Because you need to understand how you trade, what do you succeed at trading best, and what you don't do best. Because you need to have a plan before you go in trading with real money, before you even think about, I can make this much in a day. Because it's a process at the end of the day, detached from the money and attached to the skill.
Speaking of trading, do you think I could get 100% success rate? 100%.
What you mean 100%?
Like 100% probability of getting every single trade right?
No, it's impossible.
You sure?
Yes, it's possible.
Has anybody ever done it before?
No, it's impossible.
Like
if a minimum of 100 attempts, it's impossible.
Like for every... Should I switch it up right now?
Yeah, the probability that you'll get every trade right is not true. Like, there's got to be actually zero.
Can you get every? Okay, nobody's saying anything.
Yeah.
Okay, so what do you think is a reasonable probability that you get something right? Like reasonable. Like, let's say you're experienced in it. Like most people, what, 80%, 60%?
Okay, so there was actually a guy, forgot his name, but he had a 5% hit rate and made over $100 million trading.
Yeah.
He had a 5% hit rate and made over $100 million. So what that means is he had good risk management.
Mm-hmm.
He cut his losers quick, and his winners were monsters.
Yeah.
So what your hit rate is does not matter. It all matters about your risk management. You can have a below 50% hit rate, but for every winner you make 2 and every loser you lose 1, you'll be profitable.
Yeah.
You see what I'm saying?
Yeah.
So it's all about risk management. You may ask, what is risk management? Risk management is simply just limiting the amount of risk that you are exposed to before you get in a trade. So what that means is, let's say you're predicting the stock's going to go up. Let's say this is at $100 for Apple. Your stop loss would be $99. That means if it gets below $99, no matter what, you're getting out. That's your risk management. And maybe your take profit is $105.
What's that called? That's called like a stop limit.
A stop loss?
Stop loss.
Yeah, it's called a stop loss. And then there's also called something called a risk to reward ratio.
Yeah.
So that would be 5 to 1. Because you're going to make 5,
but
if you lose
only
1.
lose.
And that means you can have a 20% hit rate to be.
Those are hard to find. The ratio 5 to 1.
Yes, they are, but that's why when I say paper trade, you can establish a plan for yourself where you may actually find systems like that. There are plenty of systems out there. Like I think my if I were to do like some quick math, my hit rate, our risk to reward ratio is like 4 to 1. So I risk 4 points to make like 20.
Yeah. That's pretty impressive.
So
if you were to bet $20, you'd lose 20, but you gain like 100.
Yeah.
Or 80. Sorry.
Yeah, basically that's how it works.
Wow.
So I can lose 4 times for every 1 winner.
Yeah.
And be profitable. But yeah.
I personally don't agree with this, but would you say trading is kind of like gambling?
So technically, yes, trading is gambling. It is gambling because if we look at the definition of gambling, it's like predicting an outcome that you don't know what's going to happen. And that's what trading is. We're predicting it to go up or down. Do we know if it's going to go up or down? No.
But we can try and ensure
yes.
that's
Now, we can have technical analysis, which helps us make the best educated guess possible. But trading is gambling, but it turns into gambling if you don't have proper risk management.
Yeah.
Because after that, you're just throwing away money. You have better off odds in Vegas than you do in the market.
Yeah.
So, yeah.
Yeah, definitely.
Yeah.
I mean, that's all I have for today.
That's all you had today. So, appreciate you guys, your time. Here we have, once again, this is Liam. I'm glad. Thank you for your time, and we will see y'all in the next one. Peace.
Yeah.